Welcome to M&A Talk, the #1 podcast on all things related to mergers and acquisitions. Brought to you by Morgan & Westfield.
What is a pre-money valuation? We hear that a lot in the VC venture capital world. For those that don't know, what is a pre-money valuation?
So that's a fancy way of saying, what is the company worth at this moment? The moment we're having this conversation, what is the company worth before any transaction is consummated? And it's a very important concept, and it's a very misunderstood concept, because you can't really have an intelligent discussion, in my opinion, about any financing transaction until you first have a firm grasp on what the pre-money valuation of the company is.
Now, a technical question on that. Well, two questions. I'll ask the technical one second. Are these minority or majority investments typically for growth equity?
Castle Placement does both. I would say we've probably done about, if I had to take a guess, 2/3 majority investments and 1/3 minority investments.
2/3 majority. Interesting. Okay. So on a minority investment, is there a minority discount for valuation purposes because it's a minority piece of equity that doesn't have majority control?
I think I know what you meant, but the way I would look at it, as opposed to a discount, I would call it a premium. I would say that the fact of the matter is, usually if a company is in a bargaining position where they can attract capital from minority shareholders, it's usually a pretty hot company, and it's usually going to be a premium price.
Right. Okay. Because in the appraisal world, I don't do certified appraisals. Most investment bankers and M&A intermediaries do not. But I know when you're preparing a certified appraisal that's going to stand the rigors of a courtroom, you have to apply certain discounts and premiums and so forth. And one of those discounts is a minority discount. And I know you can get pretty technical. And most of the time, I think we see those at around 30% or so.
It's incontrovertible that if an investor has an opportunity to invest either in a minority share or a majority share, you have to give that investor a discount to incent them to take the illiquid alternative. But most transactions that we see, it's not like that. It's really more like the company makes the choice whether they want to sell a minority or a majority share. And they would usually prefer to sell a minority share.
Right. How is this different, or how might this investment be structured differently than a venture capital investment? Or how is the world of growth equity from a private equity standpoint different than venture capital investments?
Yeah, it's very different. We do both. So Castle Placement does early stage companies and middle stage and late stage. Early stage companies have very little bargaining power for the most part. There are exceptions. There are really hot founders and really hot companies and hot industries where there's an incredible growth trajectory that has been demonstrated, or a large customer base or subscriber base, or software as a service where you're really starting to get major traction. Then the company has bargaining power. But for the most part, the venture capital firm has most leverage and can negotiate a lower pre-money valuation, as we discussed before, and better terms like preferred stock and senior priority investments. So it's a different world. When you have a mature company that has a track record of revenue and earnings, the whole nature of the capital raise is quite different.
So for the listeners to the show again, the private equity world, venture capital, of course, is technically private equity because it's equity that's private. It's I don't know the numbers offhand. I've got a stack of books here, and one of those books, they've got some statistics. I think it's like 10 or 20% of the private equity world. Growth capital, I think, is like 20 or 25, maybe 30% of the private equity world. and the remainder is for acquisitions, outright acquisitions. If we just back up again to make this crystal clear for the listeners, how is growth equity different than an outright acquisition? And how might the objectives be different for the two different people pursuing those two channels? Because I know sometimes there's a little bit of gray area there depending on the entrepreneur's objectives.
Yeah, I mean, they're quite different. I would say the analysis is extremely different. There are commonalities. In both cases, you need to study the company and the competition and the financials, both historical and projected. But I'd say the major differentiation is the management team. For growth equity, you're making a bet on the management team and how they're going to steer the ship going forward. And that's more important today than it has been in history because the waters, if I could stay with that analogy, are quite treacherous and volatile. Technology is changing at an incredibly rapid pace, and all types of new modalities are being implemented, it seems, every week or every quarter. And the management team, just because they've done a good job in the past and just because they're doing a good job today, doesn't mean that they're going to do a good job in the future. So if you're making a growth equity investment, you better spend a large chunk of your due diligence, time, and resources studying the management team and their ability to steer the ship going forward. In an acquisition, of course, you care about the management team, and sometimes you retain the management, sometimes you put in your own management, but it's a very different calculus.
M&A Talk is brought to you by Morgan & Westfield, a nationwide leader in mergers and acquisitions for small to mid-market companies. If you've enjoyed this show, don't forget to subscribe and leave a review. Learn more at morganandwestfield.com. While we take reasonable care to select recognized experts for our podcast, please note that each podcast presents the independent opinions of such experts only, and not of Morgan & Westfield. We make no warranty, guarantee, or representation as to the accuracy or sufficiency of the information provided. Any reliance on the podcast information is at your own risk. The podcast is for general information only and cannot be considered legal or professional advice.